What's up, everyone? Welcome to the daily macro update for Tuesday, November 25th. Taking a look at the S&P 500 here, we're having a bit of a bounce. I just posted a video talking about how a lot of the mainstream media is talking about this incredible bounce, saying that, we should be FOMOing into the market essentially. And so what we were telling our community, as well as what we are doing ourselves, is we are using this bounce in order to clear out any losers, as well as to take some profits on things that are up a decent amount on this lower volume week. Whenever we have a holiday week, it's typically a lower volume, and so it's very important to pay attention to what price is doing on those low volume weeks so that we can either clear things out like we're doing right now, or if it's something where we're experiencing a little bit of a steady sell-off to the low end of the trading range on lower volume, that would be presenting a buying opportunity, which is not what we're seeing right now, though. This is more of a raise cash, sell a little bit, kind of a nice little reset before volume comes back next week. And so that's really, what we're seeing here today. I can even pull up some volume chart on here. As you can see, this pretty stark drop off on this bounce here is what is showcasing. Now, from a price perspective, yes, it did come back as a bullish trend, but this bullish rebound, reclaiming its bullish trend, just put a little asterisk next to it, because if or when volume comes back next week, normal trading volume, if this does show a drop off in price as volume comes back, then this could easily go back to either a neutral or a bearish trend. Okay. So when trends are flip-flopping like this, it's typically a signal of something. And so we want to make sure that we are taking that into consideration heading into this week. So do the opposite of what the mainstream media is telling you. Use this opportunity to consolidate on things that have been losing trend in your portfolio. And not direct financial advice. That's just what our process tells us to do. And so that's what I am sharing. Now, taking a look at some of the macro data here today, we did get a decent amount of macro data here finally. A lot of it is showing that a lot of it is in support of the rate cuts that are now a heavy majority of happening for the December 10th meeting. First, let's take a look at the producer price index that was shown today. Now, this was, I believe, for the month of September, so we are a month behind on this, but it did accelerate a little bit less than expected here. So as we can see, the September PPI, which is incredibly lagging. I mean, we're almost in December now, but that showed a number of 2.9%, a little bit lower than what we saw over the second half of last year in 2024. And so we are seeing an interesting lower number there. With retail sales, looking at the year-over-year number, we can see that this still is remaining pretty high as well, considering the entire previous year. When we take a look and zoom out on the retail sales number, let's actually just go through the past couple years here. As you can see, compared to 2024, retail sales has actually had a decent rebound. And so, consumption has remained relatively stable despite, a lot of the turbulence that's happening in the labor market as well as in the services sector. Now, that could be because just more people are consuming on credit, and so there's a lag effect that's there. We'll see how that plays out in the next year or so. But from just looking at the nominal number, it seems that consumption is somewhat remaining steady for now. Again, putting into the narrative of stability. Home prices, looking at the Federal Housing Finance Agency home price index here, looking at the year-over-year change. In September, this was at 1.7%. Zooming out here, this is one of the lowest readings in quite some time. If we take a look, I think over the last 10 years, I believe it won't let me go back as far, but it says that this was the lowest record number since 2008. So that's pretty interesting there. And then taking a look at some of this other macro data, some of the private data, looking at the 5th District Service Survey for the Fed, for the Richmond Fed, we can see that this did have a decent contraction, and we haven't seen a contraction since June of this year. So the services sector for the Richmond Fed area did have a little bit of a decline. We also got the Dallas Fed Services Index, and that also had a deceleration into contractionary territory, although it was less than October, which you could view as a positive rate of change, but still with it being negative, that's not necessarily what you want to see in terms of strong growth. And so it's interesting, right? When you have the Atlanta Fed, and I can pull up that chart here while I'm talking, it's interesting seeing the Atlanta Fed's GDP nowcast remaining at a pretty decent number, while we get real data that is showing the complete opposite of what that is suggesting. And so today, the Atlanta Fed's GDP nowcast showed a GDP estimate for the entire year of 2025 at 4.0%. Now, on the surface, people will look at this and be like, oh, wow, the economy grew a lot in the year of 2025. But when you take a look at the real data, as well as compare that to what the government has been doing in terms of bill issuance, going into debt, spending, that is really what's been propping up the GDP number for the nowcast. Pretty much the entire economy right now is being propped up on this short-term debt issuance that the government is currently in. And this is because interest rates remain higher, as well as inflation remains higher. And a lot of this debt that the government is going into, which is expanding the deficit, I think we have either 6 or 7% deficit to GDP levels, which is absurd. You only get that during high conflict, like World War type of scenarios. And then also, too, when you take a look at the debt to GDP ratios, now that's nominal debt divided by GDP instead of just the deficit, we can see that that's above 100%, which the last time that's happened in the United States was in World War II. And so it's clear that a lot of the estimated GDP numbers for this year are due to the fact that the government is propping it up with the debt issuance. And the main reason why they're doing that as well is because a lot of that debt issuance is going into AI investment. Because really, a lot of these AI companies, when you take a look at their operating expenses and how much revenue they're generating, these AI companies haven't figured out a way to stay or to actually make a profit yet. And so isn't it a little bit concerning that the AI bubble continues to be fueled by our own government going into debt into companies that don't even make money? They don't even have a business model that is generating a profit, which to me, that signals that there's a very low level of value that AI is currently being able to provide. And so this disruption with an insane amount of AI investment from the government, as well as they're using that type of investment as a way to say, oh, okay, all these things that are going on in the AI world, we don't have to hire entry-level jobs. It's a huge disruption that isn't really showing any type of benefit so far. In fact, it's doing the opposite. It's not providing more value to these companies, and it's causing us to go into wartime debt and deficits. Does that seem like a winning type of strategy right now? Does that seem like something that is investing into our future in a prudent way? To me, that seems incredibly irresponsible. To me, that seems like a gamble. So I don't know I don't know how this will materialize, but just from looking at the differences between the actual numbers, which we're seeing again in all these different real, indices here, growth clearly is not in a positive trend here, and inflation remains near 3%. In fact, when we take a look at the Cleveland Fed inflation nowcast, they have headline inflation remaining at a clear solid 3% into November. So, all the while, the Fed is about to cut rates again. Do you guys see what's on the wall here? The silent tax, that is inflation, is accelerating. Taxes are going up. The silent tax is going up. People need to realize that in this country, everyone is a serf, S-E-R-F, not S-U-R-F. Serfdom, for those of you that haven't studied ancient history, those were people, those were laborers who had to work for their they were slaves, right? So these are forced laborers, and a lot of them, at least they knew about it. Whereas these days, the modern serfdom that we're experiencing right now, most people don't even know that they're slaves. And when I say that, I mean financial slaves, because the banks, when they create money out of thin air, they are causing people to go into a lot of debt, as well as they are inflating away our purchasing power. And so we are being sunken into this debt slavery that can only be repaid back by labor, right? So the interest on debt can only be paid back in excess labor, whether that's taking over another job in order to pay off the interest or whatever. When it comes down to it, the government is essentially issuing debt or creating money out of thin air and then charging interest on it. And that is what creates even more money, which accelerates the money supply, which causes inflation. And that's really the spiral that we're seeing right now. Right? So all of us collectively are financial serfs. There's only, like, people like to say, oh, the United States, we don't want it to be like a socialist country. Well, one, it's pretty much a socialist country if you realize how many people are living off the government and how a lot of it is just taxing people and redistributing that money. So already, if you just look at it, there's a lot of ways that the United States is already a socialist country. But also, two, it's not a socialist country in that everyone benefits. Really, it's just benefiting a small group of elites, which that's a plutocracy. Some people say it's an oligarchy if it's like a group of, or it's an institutional class. I'm actually not sure what the difference is between oligarchy and plutocracy. Let me see real quick here. A plutocracy is ruled by the wealthy, while an oligarchy is ruled by a small elite group, which may or may not be defined by wealth. Okay, so it's basically the same thing. Really, it is a plutocracy, though, because it is a small, wealthy group of bankers who are essentially controlling the entire world. And that is being perpetuated by this abuse of money printing by issuing debt. And so the only way to protect yourself and your family from this is by investing wisely and playing the game. Okay, we can't change this game at all because we're just the little people, right? We're just serfs. We're just a cog in their machine in order to continue things to prop up. And so in order to combat this as best we can, we have to use our money in order to invest in a very smart way. That's why when it's like talking about the stock market or cryptocurrencies or whatever, real estate, investing your money into those things is just your way of making sure that you are preserving your purchasing power as these, plutocracy people are inflating away everyone else's. And so it's your duty to make sure that your money isn't subject to this plutocracy that's going on right now. And when I say invest wisely, it's just anything that will remain in a bullish trend given the macro environment. I saw somebody say, do you mean bonds when you say invest wisely? No, that means whatever is in a bullish trend, given the macro environment, that's what you have to own. Because a side effect of this abuse of usury, which a lot of people say, hey, usury is forbidden in the Bible. It talks about how it's a sin. Well, even back then, what it's talking about is going into debt and loaning your money without charging interest. But some could argue that, if you're loaning out your money that you worked hard for, then you could charge a small bit of interest because, you're taking on some risk there and it's your money that you worked hard for. But the problem is that these banks that are loaning out money, they didn't work hard for it. They printed it out of thin air. And so they are charging interest on basically zero work that they did. You see, that's the problem. That's the problem right there. And you guys should read more about it in this book that I'm currently reading, which is The Creature of Jekyll Island, which talks about the Federal Reserve and how it all came about. But I would highly recommend you guys watch or read that book. I have it on Audible because it's hard for me to just sit down and read things. Not sure if you can relate to that, but I would highly recommend that book. All right. So with that rant, let's go ahead and take a look at, let's just run through a little bit. Actually, let's just go through the main highlight that I want to showcase here. So the dollar remains in bullish trend. It's having a little bit of a drop here on this low volume week, giving a nice little setup again for things that are oppositely correlated to the dollar to go ahead and raise some cash there. Having a little bit of a pop in bonds as well. So these are great examples of things to take some profits on as they have lost a little bit of trend. But if you are owning some bond ETFs like IEF, TUA, things like that, great time right now to take some profits. We're seeing the 2-year bond yield as well as the 10-year start to drop at the same time. The 2-year is dropping faster than the 10-year, which is suggesting more of a dovish Fed policy coming up here on the December 10th meeting. Meanwhile, we are seeing the 5-year break-even inflation rate continue lower, suggesting that we could start to see some inflation numbers coming down. The VIX is dropping well below 20, and it did close below 20, which is actually a good sign for next week. So we'll see what happens there. Lots of commodity ETFs had a pretty decent day, such as the steel ETF, SLX, as well as the silver miners ETF, SLVP. Oil and natural gas continue to get smacked today, even though natural gas is in a bullish trend. That could have been a buy. Bitcoin still struggling though. Not seeing too much of a bounce in Bitcoin. Surprising. That's a pretty big macro signal. Let's see. Yeah, things that have just had a bounce that were down a lot, like something like Meta. Facebook, Meta, remains in bearish trend, but has a decent bounce here. Great time to get rid of that if you guys are a bag holding. Not financial advice, by the way. And yeah, that's pretty much what I'm seeing right now. Taking a look at the yield curve here in white. So you got the yield curve, and then in candles you have the S&P 500, and then in yellow here you have the volatility index of the S&P. When we enter periods of a bull steepening, which is probably where we're going to head to next after this flattening period that we've seen in the yield curve, when you have rising volatility, widening credit spreads, and you have the Fed and you have the yield curve doing what's called a bull steepening, typically if you have those things happening at the same time, then you have a decent sell-off in the markets. So seeing that volatility has been picking up, I want to see a confirmation with a continued bull steepening in the yield curve. And if that happens, then you definitely want to get out of the way in terms of the stock market. The last time that we saw this was during the tariff tantrum here. Stocks down, bull steepening, volatility up. So that's what I'm looking at here. But this is a great time in order to consolidate on any type of thing. So I'm going to keep saying it because it's worth repeating. All right. Now, if you guys are interested in trying to incorporate a lot of this macro information into your own process, as well as be a part of a community that talks about these ideas every single day, then I would highly recommend taking a look at our 6-week Macro Mastery Challenge. We have a few spots left. Just go to the link in my bio, or you can just go to macro-optics.com/macro-mastery-challenge, and you can go to the page here and book a time on my calendar where you can speak with me, and we can go over everything. So that is what I would recommend there if you're looking to expand your macro knowledge and incorporate that into your process. There's a lot of people who just focus on either, the fundamentals, or maybe they're only focusing on technicals. Those are great, but in this post-pandemic environment, you have to add something else like macro in order to supplement what you're already doing. If you're brand new to investing, having a macro foundation is definitely key. So no matter what type of strategy you have, you need to start incorporating macro if you haven't already. But that's the only thing I will shill on here. You're never going to get me shilling altcoins or telling you to just keep on buying the dips on things that are in a bearish trend like a lot of these uninformed, processless influencers are doing. So hopefully you guys appreciate that. But let's go ahead and take a look at some of the different comments here. First one over here, Touring Erard 969 says, what is your opinion on the cause or causes of the recent breaks in correlation between the S&P and the job openings rate and the potential ramifications of this trend breakdown? Which trend breakdown are you talking about? Are you talking about job openings, or are you talking about the S&P? Because as we've seen before, the deterioration of the jobs market has been so far being taken as a good sign for stocks, because that is implying that the Fed might continue to cut rates more aggressively, and the stock market will continue to get more easier financial terms, a more financial easing type of market. And so we've been in a environment where bad news is good news. And so I don't think that the opposite correlation between the jobs numbers and the S&P is a bad thing. In fact, it's been shown to be a good thing. So if you're someone who is bearish on jobs, then that could actually be something of a positive sign for the S&P, because more rate cuts, more sugar, more addiction to the liquidity. Is bull stock in a bullish trend? I don't know what that is. Weeble? You tell me. You tell me if this is a bullish trend. You said inflation is still high, but yesterday you said it's trending down via 5-year break even. Yeah, so the real macro data is still suggesting that it's remaining sticky, but when looking at the forward data, we are seeing signs that it will decelerate. That's what I'm talking about. There's a difference between what the bond market is predicting versus, or pricing in, versus what we're getting in the real data. And the real data has been delayed for so long that we really need to see what those real numbers are, because we were just looking at projections from the Cleveland Fed's inflation nowcast, which sometimes isn't as accurate. But typically the bond market is looking 6 months ahead or more. How would you suggest investing in a employer 401k during this time period? Typically, funds are somewhat limited between small, mid, and large cap stocks or bonds. Well, I can't give you direct financial advice. The Soul Wanderer 15, but whenever we talk about investing in the markets, everything is incremental. Everything is so. If you have something where you can if you do have a self-directed 401k, then I would highly recommend learning a macro process so that you can, better balance it, than one of these target date funds that will, is barely even getting you 3% when money market funds can get you 3% by just investing in treasuries. So if you do have something like that, I would just recommend learning at this point. I'm not really sure what you mean by how would you suggest investing this. Job openings in the S&P have historically been highly correlated until late. Since then, the S&P has soared, while job openings have declined. Curious what your opinion is on what? Isn't that the same question that you asked earlier that I already answered? Not really sure. I mean, I literally just answered your question before. What does the CME Fed Watch say about future rate cuts in 2026? Last I checked, they were pricing in 2 cuts for next year. I think it's 3. Let's see. Yeah, currently 1 in April, 1 in July, and 1 in December. So currently 3. We'll see what happens, but for December of 2026, that would take us to 3.21 on the SOFR. Let's go over to some of the questions here on Instagram. Activated all my short indicators. Just specific comments. How many times has the market priced in the current rate cut plan? Yeah, I mean, it's been flip-flopping because it doesn't know what to make between inflation fears. I mean, this is a difficult spot for the Fed to navigate because, inflation is still way above target at this point in time. And so, yeah, I mean, there's a very delicate, the Fed and the government are trying to perform neurosurgery right now. And they're not that very good. Is the SPY still neutral? No, it technically reclaimed its bullish trend yesterday. So, but it is on lower volume. So that's why I said put an asterisk next to the new reclaimed bullish trend on the SPY, because when normal trading volume comes back next week, if we do see a drawdown from that, then it would go back to neutral. So I wouldn't be, just because the SPY went bullish on a technical basis, doesn't mean that you just go out and buy it real quick, right? Just hold on. You should actually be selling some on this bearish divergence. Is there any deal or trial on the membership? Yeah, right now we have a 6-week macro mastery challenge where it's essentially you get access to our partnership circle for 6 weeks for free, essentially. And that way you can try it out. So if you're interested in that and you want to learn more, you can book a time on my calendar. Just go to the link in the description below. If you're on YouTube, just go to the link down in the description there. Do you still believe the labor market is due to a combination of immigration, low American birth rates, and baby boomers retiring at a fast rate? Yeah, it's a combination of all those things. Do you think it's something else other than that? Is small scale investors can join your team? Yeah, I mean we do have a lower tiered service for only $15 a month. If you just want to do that, that's fine too. What we really use the partnership circle for, as well as the 6-week macro mastery challenge, is for people who might have a larger portfolio or are trying to risk manage it themselves. I booked a time on your calendar. Awesome. But I still get the challenge if our meeting is in December. Yeah, so we're running that either until spots get filled up, which I think there's only a few more spots left, but you should be okay. If you've already booked a time on my calendar, then your spot is reserved, until we have a discussion. So yeah, you're good to go. Gball 89. All right, let's go ahead and take a look at some of the comments here on TikTok, and then we'll go ahead and wrap it up. So let me just scroll through here to see if I can filter through all of the expletives as well as interesting worded comments to see if I can find anything serious. Do you think the new dovish Fed chair coming in June 2026 is priced in yet? Yeah, I think it's starting to get priced in because we're getting more of a probability, and I forget what the guy's name is. I think it's Ascent or something like that. Bassent or something like that. I forget his first name, but yeah, he's a dove for sure. I think we need to get inflation back to 5% next year. 5%. It's at 3%. Why would you want it to go up? High inflation offset by low interest rates is a plan for success. That is not a plan for success, actually. That's a plan for just crazy prices. Who would be for inflation? That's a little strange. Yeah, I want the United States to be like Turkey. Turkey's got it all figured out. Odds of the tariff 2K dividends getting paid out on June 2026? I have no clue. All those checks are just going to go mostly to, discretionary or staples spending like food, drugs, alcohol, right? A lot of things that people just consume. That money isn't going to be used for people to invest. Maybe some people will use it to invest, but the majority of Americans, if you drop 2K in their account, they're just going to waste it, and there's going to be no change in their lives. It's similar to the same effect as when the majority of people who win the lottery, what happens? They end up right back in the same poor spot that they were in just 2 years before that, because they don't know how to manage finances. They just blow it all and party. So I'm not sure what the strategy is with this $2,500 stimulus check that Trump is going to give out to Americans, because all it's going to do is increase inflation. If you think people are going to use that prudently, you're insane. Like, you're just dumb. You're just not based in reality. So not sure what the strategy is there, other than pandering. And look, I'm a pretty neutral person politically. So, if you guys go back in my videos from, 2024, you'll see I'm bashing Biden too. What do you mean it's a great time to consolidate on things. So when I mean consolidate, when my team and I say consolidate on things, that means, you know, if things have broken trend, meaning they go from bullish to neutral, then if it's having a bounce, then instead of, if you're too heavily exposed to that asset, start to dial that back a little bit. Don't be so heavily exposed. So disproportionate allocation, consolidation means dial it back a little bit. Iceman, thank you for the follow. Appreciate the likes. Okay, we're caught up now. All right, let's see. What does the 13-week Treasury bill? Yeah, great call out there. So let's go ahead and bring that up actually. IRX.P. Yeah, I mean, this is saying that the Fed's going to cut. So it continues to drop. Good call out there. Do you think inflation will return to 2% with how much money is being printed? Not in the short term. If you take a look at the summary of economic projections for what the Fed produces every quarter, you can see that they continuously push out the timeline for their 2% goal. Where they used to say that we're on track to it, they've switched their verbiage to say, you know, in the long run, the inflation rate will be 2%. But what do they mean by the long run if they keep on pushing it out 2 years? That could mean 10 years, 20 years, meaning that we're going to have persistently higher inflation for a pretty long time from here. So who knows, you know, when we'll get back to 2%. All I know is that to get back to 2% pretty quickly, you would have to go into some type of major economic slowdown, possibly a recession. Recessions definitely help get inflation down, as well as they help with getting interest rates down, but obviously in a bad way. Good questions, good questions. Hi, Johnny. With current market, how do you feel about dividend stocks? Do these stocks tend to perform better when tech stocks retract? SCHD. Yeah, I mean, dividend stocks, you know, it really just depends on what works best for you. I mean, this currently is in a pretty weak trend. So something like this wouldn't be anything that I own currently. It's pretty much just been going sideways, so there's better things to own. The sessions are only for 50K and up. Well, that's what we recommend for people who are joining the partnership circle and doing the 6-week challenge. That's not necessarily a mandate that you need to have, but from what we've seen is that people with at least that amount or more are pretty successful when implementing our process their own way. So yeah, I mean, it's definitely not a mandate, but we've just seen that. That's what we've seen, and that's what we recommend. All right, let's go ahead and clear it out there. I appreciate everyone for joining. We will still have a daily macro update tomorrow, and none on Thursday and none on Friday. So after tomorrow, we'll be back on Sunday for the Sunday macro wrap up. Hopefully, we'll be able to have it. I know that my cat did have an issue there. Both of our cats. Luckily, they're okay. But yeah, we'll continue on Sunday after tomorrow. But I will see you tomorrow. Is there no option less than 50K? Yeah, we also have something that's $15 a month. But all right, everyone. I appreciate everyone for joining. Good luck out there, and I will catch you in tomorrow's daily macro update. Bye, everyone.